This is Kurt Kringelis, Head of Credit Strategy for Voya Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. Hints of stability in the second half of October proved to be fleeting as the sell-off resumed, with the fundamental impact of lower oil prices on energy companies having a distinctly negative impact on the credit markets. As a result, the fixed income markets delivered some of their worst monthly excess returns of the year in November. The corporate-related sectors suffered the bulk of the impact, with the corporate and high-yield markets giving up almost all of their remaining year-to-date excess returns. The sell-off also hit the emerging markets hard and cut the year-to-date excess return in half. Year-to-date excess returns are still generally positive, and year-to-date total returns are in the low to mid-single digits thanks to the benefit of the decline in Treasury yields, but continued weakness in oil prices will likely push returns lower. Within the U.S. investment-grade corporate market, the string of negative excess returns continued for the third consecutive month. Excess returns were once again the weakest in the commodity-sensitive industries. Oil prices have sold off relentlessly since the end of June and have taken the markets lower. Excess oil supply and strong U.S. dollar are key contributing factors to the weakness in oil prices. Conceptually, this should be a positive for the non-energy related industries, but the benefit has not been strong enough to offset the negative fundamental impact on energy companies. Consequently, excess returns have been negative across the board. Stubbornly high industry return correlations and heavy new issue supply have also helped to keep market excess returns in negative territory in recent months. The results in November were consistent with this recent trend. On a year-to-date basis, the industry excess return positioning continued to evolve in response to further market weakness. Excess returns now show notable industry bifurcation, with roughly half of the industries in positive territory and roughly half in negative territory. Utility and consumer non-cyclical industries are the clear laggards. Commodity prices have played a role in this dispersion along with other idiosyncratic factors and duration or interest rate sensitivity. Spreads continued to widen in November in conjunction with the weakness in commodity prices. Strength in the equity market has been supportive of spreads, but higher volatility and uncertainty surrounding the direction of commodity prices pose a risk to equities and to spreads. New issue supply has been another negative factor helping to push spreads wider in recent months, but we expect this supply pressure to fade heading into year-end. Given the strong U.S. payroll report, there is now a growing risk that the market once again reprices its expectations in relation to the timing and path of Fed tightening. Expectations surrounding U.S. monetary policy and the near-term direction of oil prices will probably control the direction of spreads heading into 2015. Spreads are relatively attractive at current levels, but the market needs to see stability in oil prices and to get comfortable with the path of monetary policy before any rally can take place. Even with stability in energy prices, the potential for monetary tightening in 2015 could lead to a sufficient enough overhang on the market to constrain the amount of spread tightening, while any supportive statements from the Federal Reserve could set the stage for a meaningful improvement in spreads.